I need some traction. You need some traction.
Thank you, Lloyd.
Let's
Great
get
to
some
be
traction.
back with the Traction Comp audience, and really appreciate the forum, given the COVID adjustments. Teleporting into all of you here online is a pleasure, and awesome to be tag teaming this with Elle, who's joining from a few miles away and teleporting in here as well. So thank you, quite sincerely. What we have for you today is more of an interactive version of our annual State of the Cloud report. We each year try to synthesize the learnings and the takeaways from the industry and share that out, both for the benefit of our portfolio companies as well as the industry overall. And this year is particularly momentous for a combination of reasons. There were a series of milestones reached in the industry, which we'll highlight, as well as essentially celebrating the 20-year anniversary of the cloud in reality, in terms of the foundational dates of many of the pillar companies. And so we thought it was a fitting time to do a broader look back on the industry evolution, as well as many of the metrics and best practices that we always try to highlight that we're going to go into more deeply today. And so this report in its entirety is available online, as well as a number of other resources. And so I'll put up here two particular things I would call out for you as follow-ups to the extent you have interest. If you go to our website at bvp.com/cloud, we try to constantly refresh the cloud resources for founders out there. And in addition to this full State of the Cloud report with kind of video and text and downloadable, there's also a number of other resources, one of which we've recently launched, which is a podcast with the individual CEOs that make up the Cloud Index, so the leading public cloud companies, as well as over time the Cloud 100, which are the leading private cloud companies. And so you'll have the ability to go deep with individual CEOs and hear their foundational stories through IPO, which is the stage I suspect many of you are in right now, as you're in this fabulous vortex of building great cloud businesses and all the wildness that's coming as part of that. And so the presentation will be available, as some of the questions are already asking, online, and there's also video recording and text, so steer you to these sites to see that. But today what we're going to be able to do for the first time actually in a real State of the Cloud discussion is open up for Q&A at the end. And so feel free to submit questions throughout as they come to you, and then Lloyd is going to DJ here as we've done many times through the years and always have fun with it. And I suspect we won't be able to get to nearly all the questions, but we'll try to at least bucket them into the most important ones and be able to hit on some key themes while we have you all live today. And so in terms of the objectives, we're going to get that macro perspective. We'll go into some of the fundamentals. We'll do the Q&A side, and then we'll steer you back to some things in terms of resources that are available for your personal follow-up. And without further ado, let's dive in. And we're going to start with the year 2000. As I said, looking back 20 years, there were many things notable about this, including that within a few months of each other, you had Salesforce and NetSuite and PayPal all being founded. Many of you may be aware of the SaaStr conference and Jason Lemkin. We do a lot of work with them as well. EchoSign was founded in those days by Jason, and then Trigo Technologies was actually an early SaaS business that I was founding during those days in January 2000. And on the bottom, you'll see here that the 0 represents the number of private cloud unicorns worldwide. And in fact, it represents the entire history of time, the number of private unicorns of any ilk. There was not a cloud company, a software company, a consumer internet company, or otherwise. There had never been a private company, venture-backed, worth over $1 billion. And in the entire cloud industry, there were only tens of companies worldwide. It was a new phenomenon, and it was really contrarian at the time to even be diving into it. And so that was the framing that we launch off of into the bigger picture. And if you fast forward in chunks, let's jump ahead 10 years, because those were slow times and it took a while to build here. But as you got to 2010, a few things jumped out. One of which is that you got into these hundreds of companies at that point, where you started to have the Atlassians and Workdays and ServiceNows of the world were being formed, and even a few early IPOs, which we'll talk about in a minute. But notably, you have this number 1 here, which is the number of private cloud unicorns. And we were proud investors in LinkedIn, and they became the first private cloud, almost 100 private cloud unicorns. If we were to do our Cloud 100 today, there would be almost an entire list comprised of these cloud unicorns, 86 in total and counting. And these are the household names that in years prior would have been public companies worth billions of dollars. But these are the Stripes and HashiCorp, Snowflake, Procore, UiPath, these fantastic names that you know well that are starting to populate and really be the leading indicators for the public trends that are going to play out from there. And I apologize for some internet connectivity, but I think we're back. So I'm going to roll with it. I also want to draw your attention to the title here, the exponential cloud growth. And in our industry, we talk a lot about hypergrowth. And usually what we mean is that really steep linear curve. But in this case, we really do mean exponential. And you see this compounding effect as they build on each other. And you see this industry really shoot up. And one way to view that is to pull out just the top 5 public cloud companies and to look at their growth, because this visual, I think, is an easier way to capture it. And it doesn't make sense to start this in 2000 because we all know the number was 0. And it takes until really 2008 when you had a handful of public cloud companies of any scale. And we felt pretty good about ourselves at the time, where we had, among this group of 5, there was about 14 billion of total market cap. And that felt like really the start of something special. But if you fast forward 7 years from there, you get up to this $114 billion, $115 billion market cap level, just 8x, in 7 years, you had 8x growth among that top 5 bucket. And even more notably, keep that 115 billion number in mind, because as you fast forward that to 2020, you have 616 billion of market cap just among those top 5 companies. And so a 44x multiplier in terms of growth in those businesses over that time period when you just look at the top 5 companies, which is awesome and almost challenging to render. I mean, I think back of like those climate change graphs, or Al Gore up on that, that machine kind of pointing up to the curve, and that's really what you've seen. And so that's just the top 5, but let's zoom out and we can actually look at the entire landscape of all private market cap in one visual. And this is something we had fun with for the Cloud 100 this year. It's the first time we've done it, but what we've done is we've pulled together this same chart. We're going to keep constant, but it's a log scale on the revenue side here. And what you have are the 2 dimensions. You've got revenue and free cash flow margin, which tend to be really drivers of fundamental value. And we're going to build this out. We're going to start in 2000, which, as we've already said, is an easy chart to render. And really, it takes a couple of years until you build this through, where you had the ultimate softwares, you had Concur and Salesforce start to emerge. And you see these bubbles starting to populate as they shift out and to the right. But you also see the size of the bubbles growing. And the bubbles represent market cap and enterprise value. And you see more and more of these IPOs starting to come out, names that you recognize, and these massive jumps as you go forward. And as you get to 2020, what is staggering is how this entire chart is filled out. And again, a reminder of the log scale, even in that context, you've got companies that have rolled into the billions in revenue and the tens of billions of independent market cap, and in a few cases over 100 billion. And so you've got this cloud landscape now that over this 20-year period has gone through just this spectacular growth and progression. This animation, I've watched hundreds of times probably in total. I just love how you can feel and see the build out. And really, that's the world we're all in right now. We're part of this amazing trend that's playing forward, where you can sense and smell and feel what's happening with your products and with your customers as they're embracing this cloud trend. And the fundamental drivers of value, this is real revenue scale, and the companies are moving up on this chart to positive free cash flow as they're showing the leverage of this business model in a more tangible way. So when you total up all the bubbles on this chart, you get what we call a cloud index. And this is something that at Bessemer we've tracked now going back to 2011, and we formalized it in 2013 as we started publishing the Bessemer Cloud Index. And at that time, we started reporting on the industry trends, the companies, and making some projections. And in 2015, for the first time, we felt like we had line of sight to $500 billion in total market cap in the industry. We felt that you could see this building where the compounding of the industry was building out to the point where you could get to 500 billion in market cap. And at Bessemer, we like to look back and hold ourselves accountable, and I'll be the first to admit we were wrong. In fact, we were wrong by a couple of years. In 2018, we hit this milestone early and aggressively. And as the largest investors in the cloud industry, we are very clearly on record as being cloud bulls. We have invested in over 150 cloud companies. And even we underestimated what was building in this industry segment as we hit this massive milestone 2 years early. And so we then started thinking through what's possible. And in 2019, at the SaaStr conference, actually, we made a prediction of cloud 1 trillion, which was stepping back and saying we had line of sight to $1 trillion in market cap just for the pure play cloud companies. This is the Shopify's and Salesforces and ServiceNows of the world, excluding percentages of business like an Amazon or a Google or a Microsoft that were cloud and sizable. But this is just the pure plays, mind you. We could see line of sight to $1 trillion market cap. We were wrong here again. We crossed this milestone in February 5th of 2020. In this bizarre karma coincidence, exactly a year later, in fact, we went from 690 billion to $1 trillion in market cap just among this core public cloud basket. Again, excluding the pieces in those big legacy software businesses and the billions of private sector market cap that's building. And so you have this fantastic milestone that we've recently reached. Notably, even with the coronavirus volatility, we have gotten back up above the $1 trillion threshold, and these companies continue to compound value. And you get into this question then of what's happening among those other sectors. And so I'm going to show you 2 other milestones that we crossed when you get into the fundamental drivers around revenue. And the first is the application layer, so the top layer of the stack on the SaaS side. This is when you think of all the business lines, so including the Salesforces like, but this we've added back now, the Microsoft business unit, Salesforce, Adobe, which is now majority cloud as well. $100 billion of run rate revenue was crossed over the last year, just in the application side. And then if you go down the stack and look at the IaaS side, coincidentally, the same milestone was passed there. Another $100 billion of revenue run rate among the leading IaaS vendors. And this includes certainly the AWS piece, Azure, Google Cloud, et cetera. And surprisingly, when you peel this out, even pre-COVID, Amazon Web Services was on a $40 billion run rate, still growing at over 30% and throwing off spectacular free cash flow in the process. So you've got this combination of elements driving an insanely profitable 30% plus operating income business at staggering scale. And by the way, Azure and Google Cloud are gaining on them in terms of market share in the process. And so you've got this $100 billion IaaS market that's just exploding. Now with the COVID work from home enabler, this market segments, all these growth trends are accelerating, and there's been some spectacular numbers starting to come out in terms of what's happening to that industry. But it just shows all the levels of cloud where you see this building, and this trend that many of you have been fighting, headwinds for years, trying to convince people that it is the right way, it's the better way, it's a superior customer experience, it's a better delivery model, it's a better business model. Those things are starting to play out, to become obvious to the world, and they are becoming tailwinds now to enable you, as opposed to those objections you used to have to sell through. And among all of that data, the one stat that I want to highlight that I think is even more impressive is the number 94. And specifically, it's 94%, which is the percentage of enterprise businesses, Fortune 2000 included, that have adopted at least one cloud solution. So this idea that CIOs used to block cloud and object and create barriers is now done. It's all about market share within those solutions now as they start to progress from legacy software to cloud. And as you wonder how are we doing on that trend, we've got a couple of visuals to show you this. The first is this idea of cloud compounding in that exponential pattern by vendor is also starting to happen in terms of market share across the entire software industry. And certainly software continues to eat the world in tech, but the more notable trend is that cloud is eating software and starting to become the majority of all software spend. This trend, this shows the 20-year trend if you look back to 2000 as well, and you can't even see cloud registering on the graph because it started so small, as we already know. But the flywheel was spinning and the building started to happen. And you start to see in 2006 and 7 and 8, it start to register and it start to scale up. So much so that if you start to see it cross the 1/3 mark already, and the relative growth rates show you this line of sight to where it actually crosses the 50% threshold in the very near future. And as you roll forward, the vast, vast majority of all software spend is going to become cloud in the very near future. And so another way to think of this is a pie chart. And if you think of kind of relative percentage, cloud here is on the left, and this is within the 5-year time frame. And legacy software is on the right, still meaningful, but a minority then of total software spend. But then you build this chart out and you roll it forward and you see what happens in the coming years as you get this beautiful like Pac-Man effect where cloud is consuming all of the legacy spend and you get into what is truly a cloud-first world. And you step back and say, what does that mean? I'm a cloud entrepreneur by self-selection into this discussion, and I certainly want to know that the growth rates are there, but is it actually a bad thing when we get to the point where cloud becomes the majority of software? And have we lost our own market size? Have you essentially consumed all of the addressable spend in the next few years, which means for all of you ambitious entrepreneurs out there who want to double and triple your business and have 20 years ahead of running room and become the next Salesforce, what does that mean for you? This picture, we think, is actually the most relevant takeaway for the market size, which is take the most conservative numbers. Start with this narrow view of what is cloud. And if you strip out a lot of the adjacencies and things that we include, you certainly can get to almost a $200 billion cloud market today, even by the conservative accounts. And then you build into that what is the conservative view of the software market, and you get to just under the $500 billion number in terms of total revenue. So there's 450. And this still shows that same interrelationship where we're coming on the 50% mark, but haven't quite gotten there. That is certainly part of the addressable market, absolutely. But really, in this world today, it's much bigger than that. We need to think in terms of software enabling technology and the multi-trillion-dollar technology market. And in fact, technology enabling global GDP. Because we all know that hardware is becoming part of the cloud stack and services are becoming tech enabled. And really a lot of the automation opportunities are rolling through to all sectors of global GDP. And so we are absolutely convinced that cloud will consume software and become a majority of software in the near future. That trend is clear. But we are also absolutely convinced that the percentage of global GDP and the percentage of technology that makes up global GDP is going to dramatically expand, which will grow this cloud TAM in the next decades ahead in a meaningful way, which creates this ongoing opportunity for those out there. And we absolutely at Bessemer are living this. We are doubling down in cloud, despite already having had dozens of cloud IPOs and being the largest private holder today. We have conviction that this trend is playing out for the years ahead. And the benefit is that you can now learn from those who've trailblazed before you. And there's some of this paint by numbers available, which will make it easier for you as the next generation of entrepreneurs and this next wave of great cloud innovators to get there faster, better, and even cheaper than those before had to do. And so I'm going to hand it over to my partner, Elliott, to talk you through some of those benchmarks and lessons learned from this first wave of entrepreneurs to help guide you in some of the benchmarks and best practices as part of the 10 laws exercise we do at Bessemer. So Elliott, take it away.
Thanks, Byron. One of the coolest parts about doing a webinar like this is I can see the chat stream. So a big shout out to all the Canadians on the chat. I'm an honorary Canadian after living in Toronto for 4 years. I think it's the best city I've ever lived in. And I think the things I miss the most are Canadian Caesars, which is a thing I can't get here in California, Porter Airlines, and we'll talk a little bit about Shopify. And I'll weave in a story about skating the canal the first time I went to Ottawa and eating beaver tails in the morning. So shout out to all the Canadians out there. As Byron mentioned, back in 2008, Bessemer took a step back and said, hey, we're seeing so much growth in cloud. We're advising all these great companies and entrepreneurs. Let's figure out what the best practices are and how we can, leverage those insights into our own portfolio and really the cloud market beyond Bessemer. Let me see if I've got control here over the slides. Awesome. So, while we won't be able to talk about all of the cloud laws today, given the time constraint, there are three that I'm going to kind of dive into today. But, what's funny is we're working with a lot of entrepreneurs like yourselves. We're all living through a really interesting time with coronavirus and COVID-19, and it feels like every week is a month's worth of data and change. So, I would highlight a couple of these that, the cloud laws are available on our website. Growth at optimal cost, clearly things have changed. Q2 and Q3, rest of the year is a bit uncertain. I would definitely read into that. For me, discovering your secret KPI is huge in a time like this because go-to-market might be a little bit different. But that secret KPI, which we'll talk about a little bit, might end up being kind of a pulse check for how your business is going ahead of where your customers might be in terms of their ability to commit to a long-term contract. But with that, let's kind of dive in. I'm having a little trouble with the screen here. Okay, so law one, in the cloud economy, scale wins. You might be sitting there thinking two things. One, that's pretty obvious, but two, I'm an early stage founder. Why should I be thinking about scale? Toby, who's one of the best cloud entrepreneurs out there, he defines it not just as kind of market share in a more traditional way in how we think about it at Bessemer, but also that to maintain real scale, you've got to put all the things in place inside of your company to set the pace of innovation. And we'll talk about that a little bit. And we'll use a case study for Zoom. Kind of timely given we're on Zoom now, and I think they've seen a unique uptick during coronavirus. If you think about guerrilla economics, we look at every major cloud category, and all of the category winners typically achieve about 51+% of the market. Zoom was no different. The real unique story was having the founder of Zoom working at WebEx, and there was clearly a time when WebEx was the tool of the day. He leaves, starts Zoom, and I'm not sure I've logged into a WebEx in more than 4 or 5 years now. But in terms of the pace of innovation, it's kind of timely with the changes in coronavirus because a lot has changed. So since we kind of put these slides together and did our original recording, let's just go through some of the highlights. Everyone goes to shelter in place. Zoom jumps from about 10 million daily active users. I know that the reported numbers are different, but they're somewhere around 300 million active Zooms per day. So what does that mean? That means that whole pace of innovation really matters because you've got an influx of new users. Your integrations might need to change. Prioritization on your roadmap needs to change. And clearly customer support has to change. So while their market share has gone up, a lot of the things that happen outside of their control, that pace of innovation really rings true for them. More recently, Verizon bought Blue Jeans Network for somewhere reported around 300 and 500 million of revenue or of enterprise value. Google announced just yesterday or 2 days ago now that their Meet product is going to be free. So Zoom's clearly adjusting to that. Microsoft is doubling down on their video conferencing inside of Teams. Facebook launched their Messenger rooms. But the big takeaway here for me is that they've always set the pace of innovation. They've maintained their market share, and even many of the new entrants into the space that I mentioned, I wouldn't call them copycats, but they've clearly leaned on some of the scale and innovation that Zoom is set over the last couple of years. In terms of scale, one thing that we've seen, Byron talked about how quickly and how rapidly the cloud market has grown and evolved. What we've also seen in that time is the pace to reach 100 million of ARR is shrinking. A lot of that is driven by, as Byron was talking about, it's kind of a cloud first world. More and more enterprises and customers are trying cloud services for the same time. And just, it's a bit of a visual chart here, but if you think about Cornerstone On Demand, which was really in the first generation of cloud companies, it took them almost 11 years to reach 100 million of ARR. You step back to Coupa, you see it's only about 8 years. Shopify did it in about 5. And then companies like Twilio, HashiCorp, Slack, UiPath are doing it even faster. So, even an early stage company, you might be sitting there looking at your Excel model, particularly with coronavirus, saying, man, it could take us a long time to get to 100 million in scale. Once you get the flywheel going, what we're seeing in the cloud market is you can scale up even faster than before. Doubling down a little bit, just looking inside of Shopify, it's a story many people know, but here at Bessemer, part of our first cloud law is something we call the second act. So all of you are probably sitting there thinking, I've got my core product, I know what my product roadmap is, but your second act is going to do a couple of things. One, it kind of wraps your product relationship around your customer more deeply and more strongly. But if you look at Shopify, only kind of 2 years after founding, they had reached 50 million of recurring revenue, but their second act in the form of payment solutions, so allowing you to transact inside of the ecosystem, represented a decent part of their revenue. And then by the time they went public in 2015, it was about 40% of their revenue. So, just consider that product roadmap. It could only be 12, 24 months before that second act or that second innovation ends up being a really, really meaningful part of your business. We've got other portfolio companies that we really admire. They found their second act in some very unique ways. If you think about Toast, they're kind of a restaurant industry point of sale technology. When they started out, they launched their second act in the form of Toast Payroll, Toast Capital. They've got a management tool set for managing your employees and your team. And I'm really proud to say last week they launched Toast Now, which is a way to allow restaurants to adapt to the COVID environment, do everything from mobile marketing, contactless delivery, and gift cards for those of us that want to support small business, but might not be able to sit down at a restaurant and do a full traditional meal that we're all used to. Twilio, for example, one of Byron's really close companies and relationships, they launched the market and they did a killer job in messaging APIs for voice, video, and chat. And then uniquely for them, they've launched organic second acts, but they also expanded into the email messaging and marketing campaign space by acquiring a company and product in SendGrid. And then HashiCorp, one of the most promising high-performing infrastructure cloud companies, they started in encryption codes, passwords, sensitive data management with their Vault product. And then they've launched probably 5 different second acts in the form of provisioning, networking, packaging, and imaging. So there's definitely different ways to go about it. Moving on to Law 3, this is sales and marketing learning curve. We're in a really, really interesting time with coronavirus. So, the beauty about this is that all of the principles of the sales and marketing learning curve still hold today. If you're in the earlier stages of the startup phase, as I'm sure many of you are, we talk about go-to-market in those first sales reps as being in the initiation phase. It's a really unique type of rep. You as a CEO are probably wearing multiple hats, one of which is head of sales. And, in this phase, you're thinking, I've got a product, I've got some marketing, customers are starting to hear about me. And now it's time to think about your first batch of sales reps who can go out in the field and represent the company. These folks are what we typically call Renaissance reps. They're people that are really good listeners, really good learners, and really good collaborators. And the collaboration piece is really big because they're able to take the learnings they're getting from customers in your first set of interactions in the field, bring it back in-house. They can work with product on adjustments. They can work with customer support, and they can certainly work with marketing and relay that feedback loop of what's working. It's typically, we advise kind of 2 to 4 reps, and you really don't want to move into the next phase until just about all of those reps are covering their fully loaded costs by about 2x. And then once you achieve that, sorry, I'm having a little bit of trouble with the remote screen here. You're ready to move into the transition phase. This is when you've got some product market fit, you've got some customers, maybe a couple of renewals, people are expanding, whether it's seats or maybe your second act is starting to tip off. And this is when you want to think about go-to-market more holistically. Those first 3 or 4 reps are still hitting plan. You can finally start to mark out quota for some new reps, but you know, the term I use, holistic, you want to think about SDRs, you want to think about BDRs, you want to sync that all up with marketing. And this is all about just the maturing part of your business. Now, here is where most companies fail, unfortunately. And it's really because those first set of reps have something unique, right? We talked about them being Renaissance folks that work up and down the organization. They were there in the early days. They probably understand the story and the nuance better than anyone. And many companies scale in the transition phase too fast. They just hire a bunch of reps, they look at their sell model and move out. You really want to be careful here. Set quota, you know, it's just a plan. Always be, you know, flexible to changing that plan, to adjusting quota, and make sure that your sales hygiene is strong. And then once all of the new batch of reps, you know, every business is different, but think about maybe 3 times the reps you had before. Once they're covering their fully loaded cost, not at 2x, but a little closer to 3x, you're now ready to move to the next phase of growth on go-to-market. That's what we call the execution phase. This is where, you know, some of the later stage companies we talked about, whether it's a UiPath or Cooper or Shopify, for example, you're really hiring what we call coin-operated reps. These folks have a book of business, a territory, they've been in the market. You know, they're not necessarily your Renaissance folks that need to learn a lot. You just give them some great sales collateral, a territory, and a target list, and they go out. You want to hire these folks as fast as kind of your pipeline can support, and make sure that you've got really streamlined process as you tack them on. And then, you know, the one kind of methodology or philosophy that we talk to our founders about is just nail it before you scale it. You know, it's just a really good way for you to think about, okay, I'm not ready to move into this next phase until I've totally nailed where I am. And then as you go up, you want to nail it and scale it again. Let's get to the next slide. Okay, so, you know, in the interest of time, I know we want to get to the questions. I'm seeing a bunch of chat questions pop up, which is great. You know, law number 9, tone starts at the top. We picked this law really because over the last 20 years of investing in cloud, you know, this law has really stayed true. And I think in the coronavirus times, it's even more important. You know, a great quote from Jen Tejada at PagerDuty: "It's important for leaders to address talent and culture like any company would address churn or competitive differentiation." Just think about that. That's a totally different philosophy to kind of how culture and values and how you work inside of your business operates. So we think about it in a framework model. You know, for me, you know, this is a bit personal because I really care about values and culture. I come from a small town in Virginia, and it's kind of in my DNA. But we really advise founders to define your culture early, make it publicly available. You know, if you've got a brain trust, whether it's your board or your senior management team, co-founder, you know, expose them to it, get feedback. But the more public you can be about it, as your company scales, you can hold people accountable, and hopefully that culture pervades its way through the organization. Number 2, try to report on employee engagement metrics as early as possible. Now, luckily, we'll mention a couple of companies below, but there's software tools that can help you do this. It doesn't have to be a manual process. And that's the same for kind of pillar number 3, which is 360 feedback. There's no reason that even if you're a team of kind of 5 or 6 that you can't do it. And, you know, one thing that I've had a lot of success with in my career as an investor and kind of advisor / board member is I try to facilitate 360 feedback on behalf of the CEO. So working with, you know, senior managers in a very kind of trusted and safe way so that the CEO can get really honest feedback, and I can be there to help deliver it. And then on the bottom, we really talk about, you know, Glint and Culture Amp. There's more tools there in the market that are available, but those are 2 that we really like. And then a special shout out to one of my favorite companies, LaunchDarkly. You know, diversity and inclusion is important for me. You know, I don't really look like your average venture capitalist, and that's okay. And as, you know, the founder pool gets more diverse, management teams get more diverse, and thankfully the venture capital industry gets more diverse, it's really companies like LaunchDarkly that are leading the charge here. And they put their kind of stance and code of conduct on D&I on their website. It's publicly available. And they really hold their feet to the fire and eat their own dog food on it, which is great. And then the last thing I'll mention is Pledge 1%. We really care about our companies and companies that we're lucky enough to partner with, putting corporate philanthropy into their own operation and philosophy as early as possible. And it doesn't mean you have to do something as big as a Microsoft or Google, one of the big companies. You can still have a good impact, early in your life. Byron's got a bunch of exposure and experience with Pledge 1%. And for that, I'll pass it to you.
Great, thank you, Ellen. I'll take back over the mouse here. And I guess two things in the transition I'll note. One is kind of as you look to follow Elliott in the on Twitter as a follow-up to this, his Twitter handle is notable and jumped out to me even before we worked together. He's the Values VC. So I definitely encourage all of you to follow him in general, but specific to this Culture Matters law specifically, which is we think it absolutely matters in all aspects of your business, including your board members, including your advisors, the extended community, and we certainly try to live this as a firm. The second thing I'd mention is he's been humble. What we should have mentioned throughout all those case studies is that those are all Bessemer companies that we've worked closely with, and Shopify is probably one of the many reasons why Elliott loves Canada, because he worked closely with them, and our partner Jeremy Levine is still on the board to this day. But a number of our companies, including many of our recent IPOs that we highlighted there, the DocuSigns, the Pinterest, the Twilios, the SendGrids, the Boxes, etc., have all done a thing called Pledge 1%. And as Elle started to highlight there, it's this idea of how do you integrate corporate philanthropy into your culture so they're not separated. And a lot of our founders for many, many years have been extremely philanthropic and very, very generous with their gains and with their success through the years. And that certainly continues and frankly dwarfs 1% of their assets, and in many cases is the vast, vast majority. But many of them came up through the years asking, how do we do this earlier, and how do we make this part of the company? How do we make it something to be proud of? And that's this idea of Pledge 1%. And we really owe Mark Benioff at Salesforce and Scott Farquhar at Atlassian a lot of credit for thinking through the structure and being early leaders here. And it's rolled through to, as I said, the majority of our cloud portfolio, and the industry at large is starting to embrace it. We at Bessemer have also taken the pledge, but it's this idea of allocating 1% of equity, 1% of time, and 1% of product. Typically, you can form it in different models to a .org entity, which most companies set up just as a donor-advised fund, so it's very low overhead, but you can start to act with that. And one thing that's notable, particularly in world events like the Corona crisis, is that it allows you to be offensive even in those community outreach efforts. And so across our portfolio, millions of dollars have already been donated to specific community outreach efforts local to them. Probably thousands of hours in aggregate have already been donated to causes, standing up websites to do PPE matching with communities, restaurant support efforts, SMB efforts, job placements, those sorts of things. And so I just encourage you to think about this in the context of how do you really establish the culture that you want at your company. It's another tool at your disposal that increasingly investors are comfortable with, and we can give you the list of supporting investors and help give you the playbook to talk to those maybe that aren't yet quite over the hurdle of wanting to support it. But it's a really neat tool at your disposal as a founder, and something we encourage you to think about seriously. And maybe as a transition into the Q&A, the one other thing we'll leave you with is the predictions slide that is the third section of the State of the Cloud report each year. We're not going to go through that in detail here because I think that the Q&A will hit on some of this, but these are the trends that we think will shape cloud in the years ahead. And every year we try to call out our shots in advance in that Babe Ruth way of sort of pointing to the goals. This is also sort of the call for companies, which is like, these are quite seriously the areas that we are most excited to invest in within cloud. If I was an entrepreneur again in the cloud space and sitting with my co-founders in our guest room like I did years ago, these are probably the 6 areas that we would be whiteboarding and thinking through how do we attack these and how can we leverage these macro trends that are happening. You've got this, the rising tide of cloud, and then you've got these tectonic shifts that are happening that will enable great companies to emerge. And so there's a lot more detail online. You can go into these, but this starts to preview some of the things we're thinking about and we're happy to get into more detail on any of those if you'd like as well. But I think to take advantage of having this audience, we're going to jump over to Q&A, but I'm going to leave you with one more thought, which is that the predictions wouldn't be complete in the cloud industry without a weather report. And so we are going to call on one of the favorite weathermen of all times to, in fact, confirm that the future is cloudy, and then make available to you again the links for additional resources with the podcast, the white papers, the full State of the Cloud report, and a lot of the social content is available here. And without further ado, then we will hand it over to the Q&A, and I will stop the screen share so that we can go to full size in your screen here. Alrighty. Lloyd, should we hit the questions straight on and DJ away? I think that we've got a bunch of great questions that have come in, and welcome others to fire away. So
let's do that. Let's do that. I'll let you guys take the first few questions. I'll chime in as needed.
Excellent. Well, maybe Elle, I'll shoot one at you as the opener, since this was one of the laws that we didn't have time to go into, but maybe you can talk about it. And the question is, what metrics are you looking at when evaluating companies? And this made me think of the 5 C's, so maybe you can give a little context there.
Yeah, for sure. So over a number of years, Bessemer's been able to benchmark these 5 C's, look at which ones matter the most, and I'll try to contextualize them. At the end of the day, in the market we're sitting in right now, I mentioned kind of growth at optimal cost. So all of the metrics that have to do with efficiency are certainly top of mind. So, you know, if you're thinking about CAC today, CAC in December is going to look very different from CAC in, you know, Q2. If you're thinking about one of our newer metrics, cash conversion score, which talks about, you know, how efficient is your burn to net new ARR, all of that is really, really going to matter for the rest of the year, because, you know, when you think about, you know, your fuel stops, which is another cloud law of ours, whether it's the end of the year, the beginning of next year, this time next year, efficiency is really going to matter. Unfortunately, or fortunately, we're coming out of a time, you know, call it the last 6 or 7 years, where everything was kind of up and to the right for the most part. And of course, you know, in the cloud market, a lot of that is fueled by kind of the macroeconomic and interest in clouds that offerings that Byron talked about. But, you know, going into next year, there'll be a really, really increased focus on efficiency. So all of the metrics that talk about efficiency in our cloud laws and the 5 C's is really, really what matters. You know, I think churn is probably top of mind for most entrepreneurs and us as well. It's kind of a underlying metric that bleeds into all of the efficiency metrics over time. So if you're sitting there and you're you know, you've got your first batch or your second cohort of customers, really check in with them. Make sure that churn is there. Make sure that you're being creative on price, on renewals, on terms, and make sure that churn is something that you're keeping your finger on the pulse of. And then I think the last one is customer lifetime value. We're in kind of uncertain times, so we don't really know what the future value of a customer is in terms of months. But you know, customer lifetime value to CAC is just an underlying metric which talks about, you know, over time, how profitable is each new logo that you bring into your customer base. So, you know, all of the 5 C's certainly matter, but the real backdrop of the market that we're in now, and I think going into 2021, is going to really lean towards efficiency of your business.
Great. And then there are several questions that I think hit on elements of the same theme. So I'm gonna bucket together here a question from Satish, AJ, Patrick, and one of the anonymous contributors, which are around what are the new areas of investment that will emerge considering COVID? How do you think about data privacy as it relates to COVID? How do you think about distributed work and contingent labor and a number of these elements? And so it was interesting, we touched on these somewhat in the predictions, but let me go deeper on 2 pieces in particular, which is we've been big believers in this cloud prediction 1, which is the future of work will be remote, which we actually published before COVID and continue to believe is a long-term trend that will be massively accelerated by the work from home mandates. So you have this dynamic where the workforce is global, and the world's best talent often chooses to be in other areas, including Canada and the Midwest and Eastern Europe and what have you. And as technology gets better, mainly cloud solutions, companies are finding that you can get access to that world-class talent without forcing them to move and wrestling with it. And so those enabling tech platforms, the basics are, of course, the Zooms and the DocuSigns and the Boxes and the Evernotes and what have you, but there's a whole class in Slacks and Microsoft Teams and all these things. But there's a next wave of tech and tools that we're starting to see that in some ways are even more exciting. And those are the types of businesses we love and want to see more of. And there's even like the Gen 1 tools, like an Evernote, where I'd love to see the leapfrog solution because it's clunky in 10 different ways and there's got to be a better answer. And there's different ways of thinking through these meetings than these Gen 2 video solutions and the like. And so we absolutely think we're going to see much more innovation and much more opportunity that come from the dual catalysts of this work from home driver. And then frankly, some of the unemployment. There are going to be some furloughs and layoffs and things of great talent that just got caught up in rough company situations. And a lot of innovation happened in 2000 and 2008 when there were those downturns. And we invested early rounds of Twilio, Shopify, and Pinterest in the 2008 recession. And amazing innovation happened. They could hire fantastic talent, and they were able to build great businesses as part of that. And then specifically on the privacy point, the way we worded prediction 2, privacy debt is the new tech debt. But there's this question of basically, is there going to be a step back in that trend because of COVID requiring GPS tracking and those sorts of things? And I think the answer is yes in the short term and no in the medium to long term, meaning people will trade privacy for safety, security, health, those sorts of things. And that's going to be required of people in the short term for social wellness. They also will trade privacy for convenience, as we see in the ad tech world and things. So there will be this two-way exchange. However, what we saw starting to emerge in the B2C space, where consumers have the right to request certain treatment of their data and security and access and deletions and those sorts of things, that's rolling through the enterprise world as well. And there will be a whole class of technology solutions that are necessary to enable and power that. And we absolutely believe that there'll be a class of companies that are started there. Excellent. So, Elle, which one do you want to pull from the great questions coming in for to attack yourself?
Someone had a follow-up question about second acts and what we're seeing in coronavirus. I'll take that one. So, look, we don't fully know what the future is going to hold in terms of people going back to work, working remote. What I'm pretty confident of, and I think the entire firm is confident of, is it certainly won't be the same going forward. Many of the CEOs and CFOs that we talk to every day are rethinking, why do I have so much office space right now? Why are we requiring so many of our employees to come in? Should our real travel policy and expense policy and cost structure be there? So I think there's going to be 2 areas for second acts that I'm pretty excited about. One is, we talk about remote work and whether it's payroll management or team management. I think a lot of the tools that we use today, whether it's Slack for messaging or Outlook or even things like WhatsApp or iMessage, they're going to launch a ton of different second acts for the work from home movement and future. And then I think in the brick and mortar business, I don't necessarily think there's going to be a huge new innovation of second acts. I just think we're in this really unique time where digital transformation was a buzzword that's been around for kind of the last 5-10 years. And we talked about it at the board level, at the management level, but there were a lot of kind of legacy industries that sat on the fence. They talked about digital transformation, but didn't necessarily enact on it. But in this new world, everyone's getting off of the fence. So whether it's in the restaurant industry, Shopify just launched their new At Shop app, which is great. I tried it for the first time yesterday, and that's really taking brick and mortar business into the digital area. And I'm really, really excited about all the companies that are going to launch second acts in the new world.
How do you think that the acceleration to remote will affect cloud experiences, especially in technology-specific domains like DevOps or infrastructure?
Yeah, so
sorry for that. So go ahead, Al.
It's an interesting conversation. I've got a colleague of mine, we spent probably 90 minutes yesterday kind of addressing this question. There's a lot of writing and talking going on in the last month around what are the real innovations that are coming in terms of cloud delivery and cloud hosting. I think just with the volume of people doing the jobs that they usually do remote, there's going to be a huge advancement in kind of the core technology and kind of the infrastructure side of how cloud is delivered, how applications are supported and hosted, and really, you know, the amount of real-time kind of adjustments and analytics that are put into the workflow. That's generally where I'm spending a lot of my time thinking about where all this is going. But as Byron mentioned, there's still a lot of room to run in terms of where cloud sits today. So we're excited on both sides, but you know, part of our job is trying to predict the future, and it's certainly an area where a lot of us at the firm are spending time. Byron, any other thoughts on that?
Yeah, well, and sorry for the tech latency there, but I'll build that in. It sounds like one question was where are we investing, and then I was going to touch on an entrepreneur's question, which we get a lot, which is the offense and defense question for how to run the business. And you know, certainly from our standpoint, it would be unfair to say it's business as usual, but we are still very much open for business in the sense that great companies are started at all times, and in many ways, there are positives from this environment around being able to build a team and think longer term that have served us very well in the prior recessions. And so we absolutely are continuing to be aggressive in terms of new investments. From an entrepreneur's perspective, and I suspect many of you out there are founders watching this, there's this inherent tension of wanting to take share and seize an opportunity when your competitors or you know, customers are vulnerable, and yet at the same time not wanting to run out of cash and wanting to make sure that you're around to capture the prize. And so there's a balance there that I would say job one, of course, is never run out of money and don't fall off the cliff. And so there are times when you need to do layoffs, there are times when you can't raise, et cetera. But the fundamental tenets of anchor around core customers who are finding value and use them for customer financing, which is non-dilutive and aligns product strategy. And you can do some things like a little more services work and a little more customization perhaps to go deeper with them, as long as it rolls back into the product and they'll pay for it. And then the second is certainly to think about some additional cash reserves and to think about having that cushion so that you can add those hires. And the general rule of thumb is that product investments will pay dividends in the long term. You can pay down that tech debt. You can architect it to win so that as the go-to-market efficiency is there, you can lean back into it. And that's why many of the metrics that Elliott talked about in the 5 Cs, when you see that CAC starting to hit again, and maybe it still is even in the COVID era, then frankly, it would be foolish not to invest. And that's where this venture capital, us and others, makes sense, where you can, the capital is self-solving because you will be able to raise the money and you will be able to get the payback on it to build the business. And those are the most fun situations to be in, when you've been able to see that sort of the decks are clear, your competitors aren't able to throw silly money at it in sloppy ways, and you can capture the prize. And absolutely, many of you listening to this call will be in that situation in the coming months.
Sure. I'm going to try to do a couple of these rapid fire since we're hitting the end of the hour here, and I apologize, I couldn't see the questions before. So there was a question on valuation. Clearly, given we're investors, I feel like we should touch on that and give some viewpoint, particularly in the coronavirus world. There's two things that are at play. One, we're still really in the early innings of the impact of coronavirus, right? We came out of Q1, we're all kind of watching earnings reports. A lot of the impact that happened in March, those deals, and maybe even some of the customers you were talking to in your pipeline, they likely still closed, or they didn't say a hard no, they just said not right now, and you've shifted them into Q2. I think we're still kind of a full quarter away from understanding the real impact. But for private companies, there's something that I think is unique, and that's kind of the two sides I alluded to. Look, venture capital firms are still, for the most part, pretty flush with dry powder and cash to invest. But I think what will happen is there'll be a real bifurcation between top of market valuation and multiples will still stay for the companies that are category leaders, growing efficiently that we talked about in kind of the 10 laws, but are still breakout stars, right? So I don't see a huge degradation in valuations there. The difference is, the last 5 years, while everyone was kind of moving up and to the right, you could kind of fudge your way into a high valuation multiple. I just think there's going to be a line somewhere. We're still a quarter away from figuring out where that line is, where we're going to see the breakout winners still generate the top of market multiples, and then the folks that are somewhere in the middle. I think you might still have a decent time raising that next round of capital, but there'll be somewhat of a split. The other one I saw about geographic regions that we're bullish on, to be totally honest, given our prediction that the future of work is remote, we actually believe the future of our portfolio operations is going to be remote. We're finding some of the most fascinating companies with, engineers all over North America, go to market all over the world, customer support located where it is. It's just about hiring the best athletes. And luckily, a lot of these cloud software tools allow these companies to scale remotely. Personally, I spend a lot of my time when I'm not in California in geos like Austin, particularly kind of the Toronto Waterloo corridor and Montreal, partly because I enjoy going there, but there's just incredible engineering talent coming out of Waterloo, and then incredible kind of data science and machine learning talent coming out of Montreal. So that's where I'm spending a lot of my time. We're a global firm, so we've got coverage, a great team in Israel. We're doing a lot more in Europe, India, even some things in China. But that's where I'm spending my time.
Excellent. And I know we're coming up here on the hour. We still are getting a lot of questions in. So maybe what we'll do is go another 5 minutes if people can stay a few minutes over, and then we'll attempt to have some follow-up format where I suspect Lloyd and team will do some follow-up by setting out the content and the like, and we can figure out offline how to connect. But there's some questions, a lot of questions around the COVID era and multiples and markets. And so maybe I'll bundle a few here, which is there's a question around multiples for storage and collaboration businesses. Why are they trading at low multiples? How do we think of deal flow and implicitly valuations in this environment, which Elle talked about a little bit? I would say that the Dropbox and Box things are very different, which is there's fundamental free cash flow questions there, as Microsoft Teams and SharePoint and Google Cloud have hit them pretty hard. And so that's a function of the acquisition dynamics and customer lifetime value. They're still multi-billion-dollar businesses. They are far from failures, but they've hit local plateaus and certainly have some challenges to get back into the decacorn potential. And I think that's fundamental to business characteristics. But in terms of thinking through the types of businesses, and there are also a number of questions around these freemium funnels and lower cost acquisition and API businesses, we think that figure out what your business model is and nail the unit economics for that. In their cases, Box has a enterprise heavy selling motion, and so you need to have the higher price points, the lifetime value, the higher retention, the upsells to go with it. If you are a lower friction model, like a HubSpot or Zendesk in the early days, or Slack or some of these things, as well as the true freemium tools, you can afford to have higher churn because your acquisition dynamics are very different. And so you don't need to be everything to everyone, but be very clear, particularly in this time where you need to focus on your ideal customer profile, have that selling motion that maps to it, and be pretty rigorous in tracking your leading metrics to make sure that you are truly on that path to best in class metrics against the model that you're pursuing.
Awesome. I think that we'll make that a wrap. One last question from me for each of you is, what is the one or two things you're seeing some of the most highest performing companies doing growth-wise, marketing-wise, to cope in these times and continue to get customers?
I'll let you hit that first, Del.
Yeah, so I think the most innovative thing I've seen, Q1 for a lot of companies is like conference season, right? And we're coming out of Q1 where a couple of conferences happened. I think the last one I attended was RSA. And I remember walking to a reception when I got the mass text alert from San Francisco City saying, hey, coronavirus, we're in a state of emergency, and everyone kind of stopped. tried to figure out what they were doing. And at that very reception, I think attendance was about kind of 75% down from registered folks. So we're entering Q2, folks aren't traveling. And what I'm really seeing that's unique, some of our companies are creating their own conference or online conference environments beyond just a webinar, but doing things like breakout rooms or, industry specific breakouts, taped videos similar to the ones that we did. Everyone is rethinking how they're reaching customers and kind of getting messages out in the market. So it's kind of taking folks back to the early days of growth hacking, but doing it in a fully remote cloud tools way. So I'm excited about that because those that find success in doing that, the CAC value should actually come down and they'll be a little more efficient as they grow. So I'm really interested on both the conference side as they're going digital, but also our companies that did a lot of pipeline sourcing through conferences are kind of bringing that environment in-house and going to market that way.
Great. And I would just add content marketing and video messaging to replace the events. A lot of one-to-one, video outreach and sales outreach. One of our companies, Vidyard, is a beneficiary of this, certainly, and a good tool. But there's a lot of products out there to try to get this personal experience, even if it can't be physical in person. And I think whatever you can do to replicate that will be important to build relationships with customers, partners, employees, etc.
I need some traction.